Welcome to at Quant Risk. Our mission is to simplify risk policy and implementation, making life easier for the entire community. This video is part of a series explaining the essential credit risk shocks required by regulators. If you find this useful, don't forget to like, share, and subscribe to stay updated. And follow us for more insights as we may extend this series based on your response. Today we are going to talk about something very important for the stability of banks: credit risk. Stress testing. Why do we need it? Well, the financial system works like the backbone of the economy. If banks are weak, the economy suffers. Stress testing is like a health checkup for banks. It tells us how banks will perform in bad times, during economic shocks or crises. Regulators make it mandatory because they want banks to stay strong even during financial storms. So, our goal today is to understand what stress testing is, why it is needed, and how it helps banks manage credit risk better. The main objective of credit risk stress testing is to see how banks handle unexpected changes in the economy. Imagine a sudden recession or a big slowdown. Will the bank survive? Will it have enough capital to stay safe? These tests focus on a few key areas. First, the impact on capital adequacy and profitability. Second, whether asset quality will go down, meaning more loans may turn bad. Third, what happens if the value of collateral, like property or shares, falls sharply. And finally, how banks behave in good times, because sometimes, when the economy is booming, banks may underestimate risk and lend too much. The big message here is, banks should always be prepared to adjust their provisions and risk weights based on the situation. Just like a driver slows down in bad weather, banks must strengthen their risk measures in tough times. So, how do we actually stress test a bank? Think of it as running a simulation. We create different scenarios, just like weather forecasts: normal, stormy, and very stormy. These are called baseline, medium, and severe scenarios. Then, we apply these shocks to the bank's loan portfolio and see what happens. Does the NPA ratio shoot up? Does the bank still have enough capital? Does it need more provisions? We also look at concentration risk, meaning, are too many loans given to the same industry or big borrowers? Because if one borrower or one sector fails, it can create a chain reaction. The entire exercise helps us answer one question: is the bank strong enough to handle a crisis? And if not, what needs to be fixed? The first shock we consider is an increase in NPAs, non-performing assets. In simple words, NPAs are loans where borrowers stop paying. During an economic downturn, NPAs can rise quickly because businesses and individuals struggle to make payments. So, we assume NPAs increase by 50% in the baseline case, 100% in the medium case, and 150% in the severe case. At the same time, provisioning norms are tightened. This means banks must keep aside more money for potential losses. For example, provisions for standard loans go up to 1%, for substandard loans to 30%, and for doubtful loans to 100%. What does this mean for the bank? More NPAs mean less income. More provisions mean more expenses. And together, that means profits fall. Capital adequacy can also be hit. And risk-weighted assets, or RWA, will rise because loans have become riskier. The second shock checks what happens when NPAs rise in the top 5 industries. Why is this important? Because some industries are more vulnerable during a downturn. For example, sectors like agriculture or telecom may struggle more than others. Here, the baseline scenario adds 3% NPAs. and the medium scenario adds 5%. The impact is higher provisions and lower profits. Just like before. But there is an added concern, concentration risk. If a bank has too much exposure to a few industries, one industry failing can create a domino effect. This shock focuses on sectors that are very sensitive to changes in the economy, like agriculture, power, real estate, telecom, and roads. These sectors often face stress due to government policies, demand-supply imbalances, or global issues. If NPAs in these sectors rise by 3% to 5%, the bank needs to provide more money and will see its profitability drop. Again, concentration and sector-specific exposure play a big role here. Now, let's talk about restructured loans. These are loans that were already under stress and got modified to give relief to the borrower. But these loans are more likely to fail in a downturn. So, we assume slippages of 20%, 30%, and even 40%. That means nearly half of such loans could turn into NPAs in the worst case. This forces the bank to increase provisions significantly, which further reduces profits. Risk-weighted assets also rise. Collateral is what the bank holds as security against loans, like property, shares, or other assets. If the value of this collateral falls, the bank's recovery chances go down. In this shock, collateral values drop by 10%, 15%, or 20%. This could happen in a real estate crash or a stock market fall. The impact is big, and the need for more capital, P&L, is also impacted in case of NPAs due to higher provisioning. Credit ratings show how strong or weak a borrower is. If ratings fall, the borrower becomes riskier, and banks need to keep more capital. In this shock, 5% to 20% of borrowers get downgraded by one notch. This means higher risk weights and more capital requirement. Even if these borrowers don't default immediately, it increases the pressure on the bank's capital ratios. What happens if one big borrower defaults? For some banks, this could mean a huge loss. So, in this test, we assume defaults by the top 1, 2, or 3 largest borrowers. The effect is massive on provisions, profitability, and overall stability. It shows why banks should avoid putting too many eggs in one basket. Sometimes, a group of companies is connected. If one fails, others might too. This shock measures the impact of defaults by a group of related companies. It could be the top 3 entities, the top 5, or even all of them. The worst case can lead to major losses and even a threat to the bank's survival. This is one of the most severe scenarios. What if an entire industry defaults? For example, if the top 1, 3, or 5 industries fail to pay their loans, this could happen during an industry-wide crisis. Like a real estate bubble burst, the impact is extremely severe and can lead to huge losses for banks. To sum up, stress tests are not just a regulatory exercise, they are a crucial tool for identifying weaknesses early and making sure banks can survive even the worst conditions. These tests give banks an early warning about concentration risks and help them decide how much capital to keep aside. They also guide better strategies for risk management. Thank you for listening.